So how many of you can resonate with this little cartoon? I mean, seriously, I saw that on Facebook and I had to save it, because it's true. Most Americans are waving goodbye to their money. And the reason they're waving goodbye to it is because they're locked into the thought pattern that they've been told since we were this high: put your money in the bank will take care of you. The problem is the banks are taking care of themselves and they're giving you their pennies. So if all you're getting is pennies, you're waving goodbye to your money because you're not getting anything in return for keeping your money in the bank. A lot of people go, well, the banks are safe because FDIC guarantees that deposit. And I asked them if they've ever read the actual act. And of course, most people haven't. But the act says that the FDIC has 40 years to pay you back at 0% interest. So if a bank fails, you're not going to get your money right away. If there's no money in the insurance program, they got 40 years to pay you back at 0% interest. That's really important to know. I mean, when they say, hey, we're FDIC insured, I go, really? And that's supposed to be powerful or mean something to me? And the answer is, it just doesn't. It means nothing. So we want to help you keep your money talking. And we're going to show you one option to do that. And we'll talk about a couple other options of how to keep your money talking for you and building and building and building. So what is A-List Partners? Well, A-List Partners Management is a management company that manages a Regulation D security. We're actually Rule 506, which means most of our investors are accredited, but we're allowed to have up to 35 non-accredited investors in a Rule 506. And that's important to know. Basically, your private funds offer a higher alternative than your banks or Wall Street does to your investments. There's a lot of private funds being generated or started or built in the United States. And it's because people are looking for a place to put money that's not your traditional bank or Wall Street. Your alternative types of funds, and we're going to go through a couple of them, they're great ways to really build wealth as opposed to increasing the size of your penny collection from your Wells Fargo account. I have a Wells Fargo account. Anyway, my group, or the management team, basically we're a very experienced team. You're going to get to meet many of them in a minute. They're very experienced, and we're a powerhouse team of knowledge and experience, and a lot of information can come from all these different individuals who are part of this management team. And I think you're going to enjoy the fact that we do have a large, very diverse management team, and it's going to make you feel very comfortable the way that we manage a fund. So I'm excited about our group that you're going to meet shortly. Basically, for those who know me, I've been building private funds for a number of years. The last fund that I left, the Pride of Austin Group, of which Amin is here. He's our little spy. Hi, Amin. And he's not real. He's not real clandestine. He stands out a little bit. But anyway, we're going to continue with the conservative, management style, conservative underwriting, very meticulous when we look at a project. We're going to do less lending, and what we're going to do when we do have lending opportunities, we're probably going to be calling Amin and saying, would you do this loan? Because I don't like lending, and I'll tell you why I don't like lending. We're going to go through that. But basically, your private funds are rebuilding America. Remember what community banks used to do when we had them? They would make loans locally. And of course, the big banks have been buying all the community banks, and they're saying, no, you're not doing any more local loans because that's not our deal. Our business plan is to do bigger loans on a national scale. Or if you're with Chase, I have to throw this out there. If you're with Chase, your money's over in Greece. If you're with Bank of America, your money's in China. So if you're going to use a multinational bank, just remember your money is probably not working here in the U.S. Just remember that. We're going to help rebuild communities. That's what private lending does. That's what private funds do. And we're excited to be part of that movement. We're also going to be working with people who are involved with us and help you learn different styles of building wealth with real estate as opposed to just buying and selling real estate yourself. It's very laborious and time-consuming to do that. And when you get a certain age, like my age, you want to enjoy life a little more. You don't want to be out there fixing the plumbing at midnight and fielding phone calls from people who want to rent a 10,000 a month condo downtown, and they can only afford $300 apartment in Kyle. You know, you don't want to field all that. There's a time will come where your time is more valuable to you than the amount of money you'd be making managing your own real estate. And as a long-time real estate broker, and if Erilyn were here, she'd probably agree with me. You know, it's just one of those things. So what is a Reg B security? First off, the name of this fund is A-List Partners REI Fund 1. And I'll tell you why we're doing 1 in a minute. It's a federal filing. We went through accredited investors, non-accredited. If you don't know what an accredited investor is, the SEC says an accredited investor is an individual who makes $200,000 or more a year, or a married couple who files jointly $300,000 or more a year, or you have a net worth of $1 million. That's their rule for an accredited investor. Our management fee is fixed at 5%, so there's not going to be any performance bonuses. We're a flat 5% of the fund, and then we participate in the profits beyond that of 30%, 70% going to the investors, 30% coming to the management fee. This is a very intensive management fund. It takes a lot of moving parts to manage a fund like this. And when you meet the team, you'll understand why. And when we go over some of the assets in the fund, you'll really understand why. But our preferred rate paid to investors is 8%, meaning investors are going to get a preferred rate of 8% before we start taking any profit participation. That's your annual preferred rate. We just began this fund, it's brand new. It's like most funds, they're filed an initial term of 20 years, has 10 years renewable. This is a multi-generational management team. And I imagine that Wade, being 27, is probably going to want to keep this fund going for a number of years, way beyond my lifetime probably. You know, we have 40-year-olds, we have 30-year-olds, and we have 27, I think you're the youngest, no, George's the youngest. But we have a wide range of age groups that are involved on the management side of it, and they want to keep this going beyond my ability. And I think that's really important as an investor, because if you're putting money in to build growth, you want to make sure that that fund's going to continue to build past the initial, manager of the fund. Because I'm 62. I mean, I hope I'll be around a long time, but who knows, I don't know what's in the mind of God. But at any rate, so I'm making sure that if something does happen to me, there are younger people to step in and keep it going. As in most private funds, the fund is owned 100% by the investors. What does that mean? If the fund has $1 million and your investment is $100,000, you've got a 10% ownership of the fund. The management company does not own the fund. It manages the fund. Now, the managers in the management company are also investors in the fund, but our percentage of ownership is limited to our amount of investment that's in the fund.
A requirement?
Pardon me?
Is that a requirement that you be an investor?
Yes, it is. It's stated in the PPM that the management company must be an investor in the principals of the management company, or the managing members of the management company. So, as an investor, it's a 2-year term. If you want to call it a lock-in, whatever you want to call it, it's a 2-year investment term. Now, let's say that you get sick a year into your investment, and you need to pull your money out because you have a medical emergency. You can terminate your investment and have your money distributed back out to you. There's no penalty for that. If you have a $50,000 CD at Wells Fargo, I'm going to pick on Wells Fargo a lot because I have my accounts there. If you have a $50,000 CD at Wells Fargo and it's a 3-year CD and you need the money in 2 years, you're going to have to pay a penalty to get that money out. That's your money, not the bank's money, not my money, not the fund's money. If you have an emergency and it's something that you can substantiate as an emergency, your 2-year term can be waived and we can get your money back out to you. Every investor is going to have real-time access to every file, every asset that the fund owns. So one thing that Wade does is he builds this incredible online network. I don't know what it's called.
Database.
It's a database. And then every investor will have an access to that database, and every file every piece of communication on an asset is loaded up to that online database so you can see everything that we do. Surveys, appraisals, communications, contracts, construction invoices, whatever it is on that asset, it's loaded up so you can look at it. I think that's real important. I think investors really need to know that. And then you'll get a lot of communication from me. One of the things that Pride of Austin always complained about, at least some of the investors, was like another email from David. It's like, oh my God, how many more are you going to send us? Well, I like to communicate. I like you to know what I'm thinking. I like you to know what we're doing. And so it's important to me. You're going to have a constant flow of communication from not only me, but other members of our team. We distribute semi-annually in this fund. A lot of your private funds are going to be monthly or quarterly or semi-annually. There are a few that do an annual distribution. I'm not real comfortable with an annual distribution because if you have to wait for a full year to catch something that should have been audited months ago and corrected, then you have a lot of accounting work you have to do before you can make that distribution. Some friends of mine up in Chicago have a big fund. They do an annual distribution. They literally are not available the month of January because they're constantly having to correct issues through the year. It's just, from an accounting standpoint, it didn't make sense to me. And the reason we're doing semi-annual because our assets are not exactly producing monthly income. The assets that we're accumulating will have big payoffs through the year. And so it doesn't make sense to have a monthly distribution where here's a few pennies or a quarterly distribution where here's a few dollars when we can do a semi-annual, here's a big chunk of money. It just makes more sense to do it that way. If you're a type of investor that needs to have an income off the investment, this is not the fund for you. You probably want to go to something like Pride of Austin or Stallion Funding or Noble Capital, at least here locally, because they pay quarterly and they pay you a reasonable rate, anywhere from 9 to 13% depending on their quarter. And that's money that if you need it for your budget, that's the type of fund you should go into. If you want to put money to work and get big, tranches of money, then and you don't need it to live on, or you can go from 6 months in a 6-month period without receiving income, then this is the type of fund you might want to consider for your investment portfolio. We will remain 100% compliant, and we're definitely going to be very transparent. There's not a question that you can ask me or any of the other members of the management team that they're not going to know a good answer to. And if they don't, they're going to come to me and get the answer, or they're going to refer to the PPM and get the answer, and they're going to get you the answer. So again, on the investor returns, it's an 8% preferred to the investors, and then 70% of the net profit after that. The fund, because of the way it's set up, has to divulge itself of all profits every year. So at the end of the year, whatever profit there is, even if it's just a few pennies, it's got to go back out to the investors, because it has to start January 1 as no carry forward capital. The only capital that can be in the fund is investor money. And that's really a liability. So we have to start January 1 with just whatever investor money is in the fund. There's never going to be a front-end load fee. Some funds have a front-end load fee. If you were to buy stock at Ford Motor Credit, even though it doesn't say that it's a front-end load fee, that share of stock has it built into it, and so Ford Motor has just paid your stockbroker a front-end load fee. So you're overpaying generally 105% of what the value of the stock is at that day anyway. Doesn't make sense to me to overpay for an asset, but that's the way Wall Street works. They're going to get their money regardless. Semi-annual distributions, you can reinvest your distribution, or you can receive a check. Statements will go out with checks, or with your if you just reinvest it, you'll get a statement. You can request, we're going to be very, very transparent. You can request tax returns, financials, anything you want to see, you can request it at any time, and Wade will get it out to you. Okay? There would be no hem-hawing or delay. We want you to be able to get access to what we do. So how do you invest in a fund like REI fund or any type of private fund. If you got cash sitting in a bank, it sounds like it's a safe place. I already told you what FDIC insurance means. The other interesting thing about what banks are toying with doing, and they may get around to doing it pretty soon, is convert deposits and relabel them to liabilities. Now, what does that mean to you? It means that if that bank fails, that deposit is a demand deposit. It's like it's an expense that they owe back to their depositors. If it's considered a liability, they don't owe you anything. If the banks get away with that, then having money sitting in the bank makes no sense to me. Use it to pay your bills, but not to warehouse your money. You can actually use your self-directed retirement account. It has to be self-directed because if your account's with a broker house, they're not going to allow you to invest in anything but what that broker house is invested into. So if your retirement account's with Vanguard or Fidelity or any number of these people, they're going to give you a list of 20 assets. You can choose these assets, whatever mutual fund it is. You can invest in that mutual fund, and the reason they're limited it to their 20s is because they're invested in those 20 mutual funds. Self-serving at the worst. So you have to convert your IRA or 401k, Roth, SEP, whatever it is, to a self-directed account. If you'd like more information on self-directed, we're going to have a lunch and learn May 21st, this is Thursday, where Ryan Schneider is sitting back there with Self-Directed IRA Services. He's going to actually make a presentation on why self-directed accounts are very powerful and why they're very useful for most people. And that's so if you would like more information on that, we'll have a whole lunch and learn just on self-directed accounts. You can transfer title of real estate. Let's say you have a rent house. It's free and clear, you're tired of dealing with it, you don't want to put the repairs into it. Our PPM allows you to transfer that real estate for membership shares in the investment. Then we take on the management of that piece of real estate, and either we're going to fix it up or we're going to, continue to lease it out and have the rental income come in, or we're going to hold it for a while till it appreciates in value, whatever it is, then we're going to sell it. And then if there is a profit from the sale, then that profit's distributed back to the investors. But a lot of people have real estate, they're just tired of dealing with it. And rather than try to sell it, one option is to transfer it into a fund. This is really important, particularly, I have a friend who, I call her a slumlord queen. She's got these great properties that are like tilting over in East Austin, and she's like, I really don't want to go in and fix them all up. And I said, well, then we'll just get them evaluated for what they are today. We can move them into the fund. If the fund wants to fix it up and sell it, we can do that. If the fund wants to repair it and keep it rented, we could do that. In other words, it becomes an income asset for the fund, and you don't have to worry about it anymore. And you have an asset that's producing you income without the headache of managing real estate. So that type of asset would be very effective to move into the fund. Equity positions in real estate, some people have an equity position in a development or in a big property. We can talk to you about moving that equity position into the fund in exchange for membership shares. Foreign nationals are accepted in this fund. We have the PPM written that accepts them, and as long as the money comes through the banking system, not a suitcase of cash, as long as it comes through the banking system, then we can accept them into the fund as an investor. The other thing that this fund's going to do that's really interesting is we're actually, this whole week I've been working a lot with a huge team of economists, immigration attorneys, securities attorneys, and business plan writers. We're actually going to apply and become a regional center. A regional center can offer EB-5 programs for investors. EB-5 means that depending on where your project is, it's going to be either a $500,000 investment or $1 million investment from the foreign investor. They'll be tying up their money anywhere from 5 to 7 years in a specific project. So let's say that Amin says to us, David, we have a $10 million apartment complex and we need money to lend on that. All right? So what we could do, if we already have our regional center established, we could create a fund, maybe it's ALIS Partners REI Fund 2, and the project of that particular fund is that apartment complex. And then we put it out to foreign nationals that we are taking money in for this fund for this particular project. Then we can raise that money, and since we don't like lending, we can actually loan the money to a lending private fund, like Pride of Austin, and they could loan it out and do they could work through the construction draws and all that headache. They get their little fee, and we get our little, fee, and our investors get their little fee. But it's a great little way to raise money specifically for a project. So we're going to add that component to this fund. And I have investors who already have friends who want to get involved in something like this. It's going to have a separate management company because you want layers and layers of LLCs to protect yourselves. Oh, speaking of LLCs, hi Bruce. Our corporate attorney just snuck in. Anyway, so we'll be setting up a second management company that does nothing but manage these single-purpose funds. And the new management company will be owned partially by the existing management company, and then we will have new people, owners in the new management company that want to have focused strictly on raising capital through EB5. But if you'd like more information on that, I'll certainly be glad to do it. We're probably going to do a lunch and learn on nothing but the EB5 program, and that would be pretty powerful too.